Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go over to the housing market here. Drew Redding joins us. This is his job. We hired him to be like the housing analyst. We had a housing analyst like the very early first days of Bloomberg. He's not very good. So we had to upgrade. So we got Drew Redding. We brought Drew in, and he's been a great home builders analyst. Drew, thanks so much for joining us here. Give us kind of a snapshot of what you're seeing out there in the U.S. housing market.
Sure. So the U.S. housing market continues to be a tale of two markets. We had some data on the existing home sales front this morning. We saw sales which were roughly in line with expectations at about 4.19 million on an annualized basis. Keep in mind, we're still down about 35% from the peak back in 2021. So this is a market that is still extremely depressed. The other thing you have to remember with the numbers we saw today is that they represent closings. So these were contracts that were signed 38 to 60 days ago when rates were more in the 6.5% to 7% range. So we think that going forward, you're going to continue to see a little bit of weakness on the existing home side of things.
On existing homes, are we seeing it a buyer's market or a seller's market? Basically, are the sellers willing to finally come down in price?
Well, surprisingly, we haven't seen all that many price corrections. We're still seeing median prices rise. You're actually seeing prices in the new home market come down a little bit because builders are adjusting square footage. And they're also, trying to meet the market in order to move their inventory, but not so much on the existing home front. And, at the same time, one of the key stories on the existing side has been that there's just not a lot of inventory out there in the market. We are starting to see that flip a little bit more recently, so that'll be something to watch. If we start to get a lot of inventory coming to the market, you could see more price adjustments from sellers.
But I guess the reality is, Drew, everybody thinks they're an expert on the home building business, so it must be frustrating for you because you actually are an expert. But the reality is, house comes on the market, boom, it sells in like 15 minutes. Because there's nothing out there, and it doesn't really matter where the mortgage market is, it seems like. But, Is that in fact the case, what you're seeing across the country, or is it regional?
Yeah, it's a good question. The market is regional. We had, when we started to come out of the initial interest rate spike in the back half of 22, we saw that markets in the East, which didn't rise as much during the boom time, were a little bit more stable. And markets on the West Coast, California, Washington, the Southwest, were comparatively harder hit. What we've seen now is that the increase in demand has started to be more broad-based as buyers have kind of started to get more accustomed to higher rates. I think, to some extent, if you need to move, there's not a whole lot you could do. You start to, fine tune, maybe what you can afford, but at the same time, if you have to move, you're going to find a way to make it work. Now, it's interesting that you said, despite high rates, homes are flying off the shelves. We had earnings results this morning from D.R. Horton, and they actually said that despite the high rates, they're still seeing a pretty solid demand environment in early spring, which is encouraging.
What do you mean? I'm not a home building expert because I look at Zillow and Street Easy all the time in Brooklyn?
Exactly.
Okay, that's just rude. That's just rude, Paul. Hey, Drew, I'm glad you brought up D.R. Horton because you also mentioned concessions that we've been seeing with some of the new homes. What did D.R. Horton say about that?
Yeah, so their commentary was pretty much in line with what it was last quarter, and that's that sales incentives are going to remain at elevated levels over the near term. And you have to keep in mind, when they started this quarter back in January, rates were 6.5. We're almost 7.5 now. So their goal, and builders as a whole, are generally trying to maintain a spread in mortgage rates versus what you see out there as a headline. So if we're looking at 7.5, they're trying to offer their buyers something 100 to 150 basis points below what you would get in the resale market. So they do expect rates to remain elevated. That was one of the main things coming into the quarter, is how would these elevated rates impact the use of incentives and ultimately their gross margins. And encouragingly, their gross margins looking out into the third quarter were only a touch below what consensus was looking for. And I think the fact that the bar has been lowered. If you look at what the stocks have done over the last month, the bar was lowered coming into the print. So I think investors were comfortable with the commentary they heard today.
Drew, I have a super dumb question, but if the housing market is still so tight and there is so much demand, why do they need to offer incentives?
Well, there's not a lot of inventory in the resale market, and they're trying to make their product more attractive. So part of the business of a home builder is that you need to turn your inventory over to make your business work. So they're seeing a lot of demand for spec homes. They want to move those spec homes because the longer they sit in inventory, the more likely they are to come down in price or come down even more significantly in margin. Just because there is demand out there, it doesn't mean that affordability is not bad. Affordability is still at some of the worst levels in history. And a lot of buyers are struggling out there, and they need these incentives to kind of get buyers through the door and make the math work for them.
Any markets showing signs of kind of peaking? And I'm thinking of the Miamis of the world, the Austins of the world. Have those markets peaked?
Yeah, those are two good names that you point out. Florida has been one of the strongest markets, but interestingly, what we're starting to see now is that inventory, particularly in some of those southwestern and western markets like Tampa, all down the coast, we're starting to see pretty significant increases in inventories. Now, by and large, across the U.S., inventories for the most part are still below where they were in 2019. But I think as a builder, that's really been your advantage. So every time inventories increase 5-10%, you're starting to lose a little bit of that advantage. So one of the main places we're seeing it is Florida. We're also seeing it in Austin, as you mentioned. And what's interesting with the Florida market is it's an area where you've had a lot of single-family housing converted to short-term rentals. So you're starting to see maybe some of those come back to the market. But you're also seeing a market that's suffering from high insurance costs with the storms and things like that. HOA fees are going up, so it's becoming a more unaffordable market.
Yeah, I mean, I don't know. It just seems like some of those markets have to peak, if not now. And we're going to go down in June. We're going to go down to another hot market in Nashville, Tennessee. Yes. So Alix and I will do some on-the-ground reporting.
Then we'll
on
be
the
real
local,
home builder analysts.
Yes, exactly. How hard can it be? And you just predict where interest rates
That's
are going.
What I'm saying.
Drew Redding, he is our top-notch home building analyst at Bloomberg Intelligence. Again, a significant upgrade from the first guy we had in there. So very good for Drew Redding there. Talking about the housing market again. D.R. Horton had some good numbers out this morning.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We did have some data coming out. We had housing data, but also we had the Conference Board U.S. Leading Index. I'm not 100% sure I know what that even is. It was down by about 0.3%. That was worse than estimated. The prior month was revised up to 0.2%. So that feels like that's a really big dip. Luckily, we have Dana Peterson. She joins us now from the Conference Board. This is her data. She can talk us through it. Dana, what is this? How do I read this information?
Sure, absolutely. So the U.S. Leading Economic Indicator is a measure that's been out for a long time, and lots of people look at it and see it as a gauge for where the economy is going, whether there's a recession that's going to happen over the next 6 to 12 months or not. And basically, this measure did dip in the month. And when we looked at what was actually good, it was very little, just the leading credit index and also the stock index. Everything else was either negative or flat. And indeed, when we look at this gauge over the long run, it has signaled recession. But the thing is that it's signaling weakness in some parts of the U.S. economy, but it doesn't capture all parts.
All right, so talk to us about what we're seeing here. Again, the leading index came in at negative 0.3% today. Consensus was a negative 0.1, so weaker than expected. What's driving it?
Sure. Well, things that were down in the month were jobless claims. This is for March, not for April. So jobless claims were down. Consumers' expectations for business conditions was down. Also, the yield curve was more negative. So you had a lot of things that just weren't really working well. And also permits weren't doing well. And certainly we know that the housing sector remains weak as mortgage rates have actually ticked back up and are quite high relative to what people experienced during the pandemic. And of course, that's because the Fed has raised interest rates and is keeping them pretty elevated for some time.
Dana, before I let you go, can you overlay a 5% 2-year and a talk of a 5% 10-year onto this kind of data?
Well, the thing is that we know that the 2-year yield is probably, it's reflecting what's going on more so in the Fed funds rate. Meanwhile, you still have an outsized balance sheet and uncertainty kind of weighing on the 10-year. And so that's why the yield curve is still negative. And for some folks, that signals recession, but it's not the only measure. And certainly we don't think a recession is going to happen in the US, but certainly we could see some moderation in growth as consumers kind of pull back after spending tons of money and piling up a lot of debt. But we don't think that the labor market's going to crash. It's probably still going to do well. And the Fed is still going to be looking at inflation gauges to see, can they get back to 2% and can the Fed start cutting interest rates this year?
All right, Dana Peterson, thank you so much for joining us. Dana Peterson, chief economist at the Conference Board, breaking down some of that, the data coming out of the board. The leading economic indicator came in a little bit weaker than expected today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Let's talk a little airlines here. Alaska Airlines, they had some good earnings. Stock is up 4% today. For the longest time, until just recently, when I looked at an Alaska Airlines plane and the tail fin, they have the image of an individual. You know who I thought that was until just recently? Jerry Garcia.
Who is it?
Well,
I don't even know what you're talking about.
Okay, so Alaska Airlines on the tail fin, go Google it. There's an image of an Eskimo. Up until just recently, I thought that was Jerry Garcia. And I was sitting in a Seattle airport talking to a pilot from Alaska Airlines. I said, boy, you guys are so cool. You have image of Jerry Garcia on every plane. He says, no, numbnuts. It's not Jerry Garcia. It's an Eskimo or Alaska Airlines. How stupid can you be? So that's my bubble was popped. George Ferguson, he covers all the airlines, the aerospace companies. So I guess, George, we look at Alaska Airlines, the Jerry Garcia airline. What's happening? Are they had some good numbers?
Yeah, so pretty nice, very nice numbers, actually. Pretty surprised. It's all about strength in revenue. Right now, the surprises we're seeing, like United and Alaska, if your revenue line, has come in better than expected, yields are doing better at these airlines than, again, we expected going in, then you're getting a nice beat on earnings. And Alaska cited return of corporate travel, continued strong leisure trends, and we were kind of looking for a slightly down yield number, and they had definitely with the adjustment for the panel blowout from Boeing, they would have had 5% unit revenue increase. So very strong, very impressive.
So I'm confused. I thought that the business airlines were like United and American and Delta, not Alaska Air.
So Alaska does have premium seats in the front of the airplane. So they are a business airline. I don't see them as sort of a big corporate airline because they're pretty regional, right? They're very West Coast focused, very Alaska focused, as it seems like Paul's become more aware of recently. Then they do a bit of transcon right into the East Coast. You got to be able to provide your customer service into the other important population center of the U.S. But they lack a lot of, I would say, the middle of the country routes, and they don't have any international. They partner up, or they have a little bit of international. They go into Mexico and some of those leisure markets, but they partner up with other airlines to provide that international. And it's hard to be a big business airline if you can't get your customers all the way around the world. So that kind of keeps them to smaller businesses.
Hey, George, John Tucker was just telling me that gasoline prices to fill up his Hummer, they're up almost 70% off of those lows.
$3.50 at the Wawa.
Exactly. How about jet fuel prices? Is that an issue for the airlines here?
It is. It's going to be an issue in 2Q. So in 1Q, it was a tailwind compared to the 1Q last year. But if it stays on this trajectory or just stays up these levels, it's going to be a bit of a headwind. Question will be, if demand is so strong, I'd expect the airlines to be able to push it through in pricing to the customers. And we're going to see that. I think the other big question here, too, is, we're kind of into earnings season. We've seen Delta, we've seen United, we've seen Alaska. We've seen airlines with, again, premium product in the front of the airplane. We still have to see the low-cost carriers come through, because I'm not convinced that this strength is in the back of the airplane. But we're going to see, right? As we start to see the real sort of low-cost leisure carriers report, then we're going to know how broad-based this strength is.
I mean, having it be bifurcated would make sense because that's what we're seeing in the broader economy, right? One part of the economy is doing well and the other just is not. Delinquencies are rising for credit cards. You're seeing more money being spent on credit cards, et cetera. We heard that from banks in terms of charge-offs. So if that were the case, where are we in terms of valuation for, say, the front of the plane, back of the plane carriers?
Well, I mean, first of all, airlines are always sort of valued lowly, right? They're not there. If you go for a PE multiple, you're in the mid-single digits. So I mean, airlines are kind of perennially a pretty cheap stock. But I mean, what we saw with United the other day, that big jump, part of that is them starting to close that gap with Delta, which is an upper single digits, PE valued airline. But again, they're always kind of cheap, because when things go bump in the night, airlines have a hard time with demand, right? If we had a geopolitical problem, like the war really raged up in the Middle East, you'd probably start to see less demand going internationally. All of a sudden, you can't fuel airplanes. A lot of operating leverage in this business, and so when that demand falls off hard, it really hurts.
All right, George, on the YouTube feed, I can see that you are in yet again another hotel room, which reminds me you're at another boondoggle that we are financing here. You're at the corporate, I guess, aircraft kind of thing out there in Arizona. If I want to go out there and get the latest Gulfstream, 6, what's that going to set me back? Is it competition out there? How is that market?
So the latest is going to be the 700 and the 800.
Nice.
And you're going to be up in the 70 millions range to own one of those. They're they're very long range. The 75 million US, yes. What we're hearing out here from these folks is, look, private aviation was very, very strong in the pandemic, right? As the very well-heeled, some of them were flying in the front of the airplane for Delta and United. They moved to private aviation. And what we're starting to see is some of those, those people that were flying private, unfortunately, they're moving back to the airlines. And that's part of the trend that those poor folks have to get back on a tube with the rest of us other people in the world. So that's part of the trend, too, that's helping the airlines, especially in the premium seats. They're seeing a little bit of an ebbing of demand of some of those high-end travelers. But this business is still pretty strong. Backlogs are 2 years for most of the manufacturers, better than they've been in a long time. Pricing was pretty good in the pandemic. It's softening a little bit, so maybe you're getting that Gulfstream now for, 72.
Hey, no.
See, I mean,
Paul's gotten excited.
On Bloomberg Television, they're putting up there on our YouTube feed. Isn't that Jerry Garcia? If you look at Alaska Airlines, I mean,
no, it's
gotta be.
We don't call them Eskimos; they're Inuits.
Inuit, yeah.
All right.
Paul's still focused on that.
Yeah, sorry.
I just feel bad.
Maybe
for those
Jerry
people
Garcia was an Inuit.
Could have been. Who knows?
I just feel bad that those people who fly private now have to come
have to
back.
go
I mean,
back
that's a tough stuff. That's a tough
I could
re-rating
never go back.
on that. George, I couldn't help but notice that your backdrop is the same as yesterday's, which means you've clearly been working really hard in and out of that hotel room. What else are people talking about right now?
Well, I mean, there's always talk in the marketplace about Boeing, right? We've had this whistleblower go through DC. I'm not sure, what we're learning there yet, but we're still kind of waiting on the Boeing report on how they're going to stabilize their manufacturing. So that's one of the things we're talking about. Everybody in the industry is talking about supply chain. These folks are talking about supply chain here too as well. Supply chain's still at a deficit for workers. That means that, in the aerospace business, there's aspirations for a number of build increases every year. Those aspirations are always harder to achieve given these supply chain labor problems. And there's inflation, right? So again, the very well-heeled are finding out that pilots cost more because the airlines paid them more. So now for the private jet, they got to pay pilots more. So pity them as well there. The front of their airplanes costing them some. Fuel prices are rising. Interest rates are higher. A lot of these people don't finance airplanes, but some of them do.
Yep.
That affects demand a little bit. Same sort of problems we're seeing throughout commercial aerospace.
All right, George, if you know all this stuff, if you were to go out, money and no object, and you were going to buy a private jet for yourself, what would you get?
Wow. I think I would be one of those Gulfstream 700, 800 folks, right? Because that aircraft would take you across the Pacific without a stop, and so the world is kind of truly your oyster at that point.
Nice.
So are you asking for a friend or?
Asking for a friend. Yeah. I don't know. I mean, it's interesting. I mean, there's a lot out there.
I'll stick with the Falcon jet.
You like the Falcon?
Yeah, if you go up to Teterboro in New Jersey, the corporate airport there, that's where many, many Falcon jets are.
Well, we go.
And it's Taylor Swift's jet too.
Is that what T Swift flies?
Now you got my attention.
Oh, now you got your attention. T Swift is flying that, but you can go out to Marshtown as well. I hear some private jets out there as well. So
I flew on one once, 20 years ago.
All right,
it was cool.
We'll let George go. George Ferguson covers all the airlines and aerospace for Bloomberg Intelligence. Back in the day on Wall Street, it was so crazy that these aircraft companies were giving us aircraft to try out and just take on road shows, giving it to us for a week. And we're like, sure, thank you. Just
Does
to try it out.
anyone kind of want to be Paul, sometimes in a past life?
I tell you, the 90s, particularly the early, it's just
And now
ripping.
He's here with us.
I mean,
how the mighty have fallen.
Exactly. I mean, we would get a plane. Hey, Paul, do you need a plane for a week? I call up on my companies and we'd go out and see clients for a week in Europe or on the West Coast.
Okay.
Crazy times.
Sign me up.
So that's why I was asking George. I mean, if you're going to go out and buy one, what would it be?
Yeah.
I guess it would be a Gulfstream.
Oh, George. All right, you go buy that plane. You can let us borrow it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alongside Paul Sweeney. This is Bloomberg Intelligence Radio, where we bring you all the top analysis from our top analysts that we have at Bloomberg Intelligence. They cover 2,000 companies in 130 industries around the world. We're back live in our Interactive Broker studio right here at Bloomberg headquarters in Midtown Manhattan. And Lisa was just talking about Netflix and password crackdown sharing and all that. They're also doing the sports thing, right? Are they doing any gambling stuff or no?
No, I don't think
so. Maybe video games. Maybe they'll do the video games. So there's opportunities here. So we wanted to get more with Mark Douglas, President and CEO of MNTN, to get a perspective of what to look at. Mark, what are you looking at when Netflix reports today?
Well, I think everyone's expecting it to be great news because Netflix gave great guidance. So the near term looks like it's going to be spectacular. I think they'll probably, really beat on earnings. The thing about Netflix right now, virtually all their growth is flowing directly to the bottom line. So this is where it used to be a company that never made money. Now it's a company that's just spitting off profits. And I think that's going to actually start to take over as the key thing investors look at rather than just looking at subscriber growth.
So Mark, talk to us about some of these revenue drivers that I know the street's been talking about for the last couple of years, one of which is password sharing, cracking down on that. The other one is the ad-supported aspect of the business. To what extent are those two issues contributing?
Well, I think the password sharing, clearly it's easy, is highly leveraged. You just get a few engineers in a room and they just make it harder to share passwords, and it creates huge amount of growth. And I think Netflix always knew they had that in their back pocket. The part about it where they're doing, kind of discounted memberships in order, and you get ads with them, that part is working well in terms of selling the discounts. I think in terms of selling the ads, it's going a lot slower for them, but they do have a ton of upside there. So I think again, that is, I think, where you should be looking. The future growth is how do they actually monetize those ads as opposed to just looking at subscriber numbers.
Here's my question. What is already priced in? You mentioned they guided it to be good. So are we in a buy the rumor, sell the news kind of thing at this point, which is unusual for what we would think is a Mag 7 company, even though it's not technically in the Mag 7?
Yeah, I'm not sure I would sell the news, but I certainly wouldn't expect the password sharing to be, it's not an endless number of people that were sharing passwords. At some point, that's going to start to tail off. And so what kind of has to happen is the ad revenue has to come on strong at some point. Right now, it's pretty weak. I think people see numbers and they're over 1 billion. But, given the number of people watch Netflix, it's not actually a huge number. So it's a lot of upside, but there's a lot of execution for them still to do. So if I were, actually, I was going to say if I were holding stock, I do actually hold Netflix stock. I've done very well on it the last few years, and I would continue to hold the stock. I think it still has a way to go in terms of growth.
Hey, Mark, I'm just looking at the financials here, and for calendar year 24, the street's got almost $40 billion of revenue, EBITDA margins 26%, free cash flow $6.3 billion. That is a good business model. How about the rest of the streamers out there? How about the rest of them? I mean, how many streamers can have a similar type of performance in the streaming business? Because you look at the stocks of the traditional media companies, other than Disney, it's a disaster out there.
Yeah, so, there's two things at work here. One is you have to reach a break-even point, which Netflix has clearly done, where, kind of the cost of the content and the number of users, kind of really line up. And then every incremental user is incremental profit and incremental cash flow. And so for Netflix, they're there. I mean, we're talking over $250 million worldwide. And by the way, I mean, why can't that be $500 million worldwide? So they're there. And for everyone else, they're just not quite there yet. I mean, they struggle to keep their subscribers. Netflix, I've always said, is like when you turn on your TV, it's the first place you go. It's like the new cable guide. Let me go see what's on Netflix rather than let me just see, what's scrolling on the cable guide to what's something to watch. And they can't lose, and people just won't let go of that. Mm-hmm. And so I think the other folks, what's going to happen is going to be a lot of consolidation. If you don't know why you would go to see, if you go to Netflix because they have everything, you go to Disney because they have children's entertainment, you go to ESPN because of sports, why do you go to CBS? Like, nobody can name that. And if you can't name it, it's not going to exist. It's going to be consolidated and just essentially bought for as a library to fill Netflix essentially and maybe Disney.
Wait, do you really have a TV Guide subscription, Tucker?
No, I don't. But I will tell you this.
When did you discontinue it?
I was cleaning out the attic and I found my TiVo. And it's just like, I don't know what to do with it. I don't want to throw it out. But I guess I have to.
I think you're going to throw it out.
Yeah.
Yeah, yep. I just made my mom throw out all her VHS tapes.
If anybody wants a free TiVo, it's in the back
Call
of my
John
car.
Tucker. Here's my very silly question, Mark, is that who is actually a true competitor to Netflix? We can name a bunch of the streamers, right? But they have so many other business models too. Like if I'm an advertiser and you're pitching me, why would I go anywhere but Netflix?
Well, I think the consolidation that you kind of start to see happening with Paramount being on the block, I think what you have to do is you have to build a big library and and have a lot of original content. And the ability to match that exists, but you have to piece together the right assets. Like you need HBO combined with buying, everything from CBS and ABC that they have in their old library. And like you kind of have to piece that together. So the question is, who has the ambition to do it? At the moment, no one, but I don't think that'll last forever. I think someone will step up to the plate. They're going to have to do it with a lot of money, though.
All right, Mark, let's just step away and take a look at TV advertising in general. Does any advertiser of merit even go on broadcast and cable television anymore, or is it just the healthcare advertisers selling me some drug for some ailment I didn't even know existed?
Well, the linear TV, it's broadcast. I think a lot of advertisers, the industry is split. Let me say it another way. The industry is split into two sections. So on one, you have reach and frequency. That's why people like the Final Four, the NBA Finals, the NFL and stuff like that. And you just want to reach a big audience at once. The Olympics, and that still plays a role. And there are, 25% of this market is not going to let go of cable anytime soon, at least. And so if you're an advertiser and that reach and frequency is your goal, that's still attractive. I think for everyone else, they want to do digital advertising, targeted, measured, things like that. That's what my company does, Mountain. We have more advertising customers than Netflix. And so, that's what everyone else wants. And there's room for both of them, but clearly you can't sustain a TV network just on linear anymore. And that's why Paramount is on the block, and because they can't get the viewers on streaming that they need to.
All right. Great stuff. Really appreciate it, Mark. Thank you very much. Mark Douglas, President and CEO of Mountain. Just looking at the stock here, doing some quick math. We look to the October low, and Netflix is up 78%.
Yeah. Yeah, just amazing. I mean, the volatility in that stock, and the volatility of the stock around earnings is always a good one. So
That's
usually
a fun
like
one.
a plus or minus 8-9% when they
That's a
release
lot.
earnings. It's a big volatility around. It's a little bit less so because it's become, as Mark was saying, a little bit less of a subscriber story, maybe a little bit more of a profit story.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Blackstone. I kind of don't remember how huge they are. And I go look at the market cap, I look at their assets under management. But anyway, we spoke with a Blackstone COO, Jonathan Gray, earlier today. He's concerned about higher rates are a headwind for Blackstone's key business units, limiting valuations and making borrowing costs more costly. And Blackstone COO Jonathan Gray thinks that the Fed may not be as quick to cut rates as investors hope. Let's listen in.
I think the Fed has had some real success on inflation. You know, we had inflation north of 9. The pace of disinflation has slowed, but the path is still downward.
Yeah. That was Jonathan Gray, Blackstone COO. But all the hullabaloo, the stock was down like 5% earlier in pre-market trading, collected more fees from big retail funds and credit strategies during the first quarter, and that really helped to compensate for that slower pace of deal exits. But like some of these numbers are huge. Distributable earnings increased 1% from a year earlier to $1.27 billion.
Yep.
That's a ginormous kind of number.
Yeah.
Let's get
They pay their executives well, I understand.
I've heard such things,
Okay.
yes. Joining us now for more is Paul Gulberg, Bloomberg Intelligence Senior Equity Analyst. He covers all these big asset managers as well as global banks. Hey, Paul, what did you make of the numbers?
Hi, thank you for having me. The numbers, I would break them up in 3 buckets. One, the fee growth, which was fairly decent, but not the double-digit breakneck growth that we've seen in years prior to the painful 2023 and late 2022. The second one is key themes, and those things are getting better. So you do get a private credit business that was working pretty well. You have a wealth management business that you mentioned that's working pretty well. They reached $240 billion in assets in the wealth management with their goal of $250, so they're pretty much at their goal. And lastly, the painful part is the deal activity in terms of deployments and particularly realizations that produce performance fees. And that sort of becomes still a pain point for Blackstone, and that's a drag on their earnings.
Paul, what have they been saying about that? Because again, you're right, we haven't seen a lot of M&A activity. We haven't seen a lot of IPO activity, the types of exit events that would allow them to realize some returns on their investments. What are they saying about the next 6 to 12 months?
Well, I would actually look a little bit beyond that, because on the call they were really talking about 2024, and before they were really hopeful for the second half of 24 to get better. But then Jonathan Gray was actually on Bloomberg TV a little bit after the call in the last hour or so, and he kind of mentioned the more return of activity is probably going to be more of a late 24 and into 25 matter. So I would look a little bit beyond the next 6 months, maybe the next 9 to 12.
If they have a hard time exiting investments, how do they then raise more money for new funds? How does that work?
Well, I think it's the issue, not just we kind of very focused on the private equity when we talk about that, but a third of their business is private equity, a third of their business is real estate, and there are some opportunities, and performance in real estate gotten a little bit better, so the fundraising came back to some extent. The BREIT, BCRED, the retail funds, the outflows kind of stopped there, so perpetual vehicles are doing pretty well for them. And the last category, the credit category, that's just been a very strong grower, and that's reached out about a third of their assets at this point.
Paul, yeah, you mentioned real estate, and of course, historically, Blackstone's been a big player in the real estate business. What is their call on office? A, do they have a lot of exposure there? And B, how concerned are they about it?
There was nothing discussed in terms of office really on the call this morning. They have about 1 or 2% of total assets in office space, maybe even less than that. So it's a fairly small amount. They are super focused on the multifamily. During the quarter, they made a $10 billion deal for Air Communities take private deals. So they're still very focused on that. They've been up for over the last 10, 15 years. They also gave some specific numbers around the logistics and infrastructure. So there's about $50 billion of investments in that already. We're talking about that's 5% of the total assets, just in that.
So I had brought up how did they raise more money if they can't exit? Did you read the Big Take article, Paul? Sweeney?
No.
It was about this. It was basically that private equity executives have had all the power in terms of fundraising, and then now the tables have turned a bit, and the deal makers are being told to put more of their own assets on the line as they struggle to wring cash from their increasingly wary backers, and that some of the junior guys have to like put up a home or like, you know, put up a car or their second home or something in order to get these loans with like very high rates in order to do that. Paul Gulberg, did you read that? What did you think of that?
I did read that. There is some of that. But on a net basis, there's still a lot of demand for all sorts of alternative investments, especially in the areas if you go into wealth where the growth is much faster and the opportunity is bigger because the wealth is a portion of the private investments. The portion of alternatives is much smaller. So there's a lot of opportunity there, and I think there's not as much power from the investors in those areas. There's a lot of demand coming from insurance companies. Blackstone has about $200 billion of their assets are coming from insurance. They earn them a little bit of extra spread. So I think there are different areas of fundraising and different areas of assets and clients that come to them rather than just what we kind of got from that article.
Private credit, Paul. What's Blackstone say about this business? It's obviously just a booming business. Assets under management are just skyrocketing. There's some calls for maybe some greater transparency, maybe even some regulation of the private credit business. What's the Blackstone take on that part of the business?
It's been very strong. As I mentioned, it reached about a third of their assets, $300+ billion. They do have a lot of different vehicles there. They do a lot of direct lending, but they also have the largest business development company, which is geared towards retail, BCRED. So that's a huge vehicle for them. There was a lot of growth. First quarter, there were actually some questions because you had a syndicated loan market, lending from the banks come back to some extent, reclaiming some of the mojo that the private credit got last year. But it's a long-term game. So over time, there's still a lot of opportunity for private credit. We ran some numbers. We think if you think of investment grade and potential for replacement, especially for those insurance companies, it could be a $40 trillion addressable market. And private credit we're talking about 1.6, 1.7 trillion right now. So there's a lot of opportunity still to take the incremental 1 or 2 or 3% of that market still.
Before we let you go, so Blackstone set the tone. What do you think the other big asset managers are going to come out with?
It's a little bit difficult because the earnings for them kind of idiosyncratic to some extent because these are private investments, they're large, and sometimes they move in different directions. There's about 2 weeks until the next one reports, so most of them reports over the end of April and early May. I think from what we've seen from Blackstone, the private credit is going to hold fairly well, which is a positive for companies like Apollo and Ares. Private equity realizations, exits is still a little bit more difficult, so it might give some pain to the guys like Carlyle. KKR, they actually pre-announced their realizations a few weeks before the end of the quarter, so we know the numbers were pretty light. So that's not going to be a surprise, but on the other hand, rates are staying higher for longer. They bought out the rest of the business from Global Atlantic, so the insurance business is going to do well and provide them some earnings in that area.
All right, Paul, thanks so much for joining us. Paul Gulberg, he's a senior equity analyst at Bloomberg Intelligence, following all the alternative asset managers. He's down in our Princeton, New Jersey office. So Blackstone is just so huge. And that private credit business has just been an amazing business. No surprise that Blackstone's got a big presence there.
You know, I was thinking about it. I was like, I don't know if I'm 100% clear what Blackstone is anymore.
Yeah.
Like, because it's so big.
I know.
I used to have a lot of lunches.
Remember, BlackRock used to be a part of that, to give you a sense of how big it it originally was.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.